My name is Andy Dix. I'm the founder of the Crowd Media Group, and we are the publishers of Crowdfund Insider. We cover all things fintech, including online capital formation. And today, we have a group of experts with us that are going to discuss risk in securities crowdfunding, or risk in private securities. We have David Carpentier of Assurely, of DealMaker, Jamie Ostro of CrowdCheck, and Atan Butler of Dalmore Group. And I'm going to ask each of you to identify yourself and share a little bit about your company. I'm going to start with David.
Hi, Dave Carpentier, CEO of Assurely. We build brand new insurance products, but more often than not, we're adapting existing insurance products for changing industries. The realities of fintech is case point number one. And then we support, so we build those products, we support businesses and with those specific products, as well as a full service insurance brokerage. Been in business for about 4 or 5 years.
Yeah, thank you, David. You're actually a pretty unique company in the services you provide, so I'm very interested to hear what you have to say later on. Let's jump over to Atan.
Sure, Atan Butler, chairman at Dalmore Group, broker-dealer, and Dalmore Technologies. Our model since 2005 has been to help empower entrepreneurs and issuers to raise capital effectively online. We've onboarded over 1,000 companies, just around 300 Reg A issuers, and grateful to be here amongst our industry friends today.
Thank you, Atan. Rebecca.
Hey guys, Rebecca Casava, CEO and co-founder of DealMaker, online capital raising platform with a whole suite of products to power making your community, your investors. We've closed close to $2 billion in capital to date through all the exemptions across North America and beyond into some international jurisdictions as well. So thanks for having me. Pleased to be here.
And finally, are we still on here?
We got you.
Technical. We're back. Finally, we have Jamie.
Hi, I'm Jamie Ostro from CrowdCheck. CrowdCheck, together with its affiliated law firm, CrowdCheck Law, provides a wide range of compliance, diligence, and legal services for capital formation by early-stage companies and the intermediaries who support them. CrowdCheck has extensive experience and expertise reaching all exemptions covered by the Jobs Act. We have a market-leading position with respect to Reg A offerings. We have prepared or reviewed literally hundreds of Reg CF filings, and we have prepared or advised on many Reg D offerings.
Awesome. Thank you very much, Jamie. And CrowdCheck's been doing this for probably the longest time for working on CF and Reg A Plus filing. So we're very fortunate to have you here today, Jamie. Okay, risk in securities crowdfunding. First of all, there is risk in any securities. That is just intrinsic to making an investment. For early stage, it's a little bit different as opposed to more established firms. I was reading some statistics the other day that approximately 10% of startups fail in the first year. In the years 2 through 5, about 70% of startups fail. That means about 80% of startups will fail with, about 5 years. Some other documents put it more at 90%. So this is a risky industry. It's just how it works. It's how a market works. There's nothing wrong with that. And it's very different from fraud. Failure is very different from fraud. But having innovative young firms, entrepreneurs, finance via online capital formation enables innovation and it enables wealth creation and is good for the economy overall. So at the same time, there is risk, and there's risk for 3 different sectors of the industry. And we're going to start by going through these different segments of capital raising. We're going to start with the investors, and then we're going to touch on issuers and platforms, because I think that that's an important element of this industry as well. But we're going to start with, and I'm going to open the question to all of you on this one, because VCs, professional investors, expect about 1 out of 10 investments to make it big. The rest are going to go bust, or maybe they'll bounce along and, you know, really not come to anything. How does an individual investor manage that type of risk for themselves? And I'm going to go around the room here and get everybody's perspective. I'm going to start with you, Rebecca.
Yeah, so I think there's a couple of different ways they can do it, right? Like the legislators thought about that, and they put caps on the amounts that individuals can invest based on their income. So that's been thought about, and that's been implemented already, so that they can't bet the house on one of these risky opportunities. They're going to be creating a diversified portfolio. So I think that's the main way. If we look at some of the stats we've seen in other more mature equity crowdfunding countries that have played out, if you look at the Italian ecosystem, they published some stats where 10% of the companies had done exits, been acquired, or gone public 3 to 8 years after the investment horizon. So that's kind of on trend with what we're seeing. And so the key to that is really having folks be able to make enough investments of companies they're passionate about and getting that opportunity so that they can see those exits.
Okay, thank you, Rebecca. Jamie, so you work a lot on these documents, and one of the things you do is you list every single new risk in a Form A, and some risks in the CF filing too. What are your thoughts on mitigating risk?
Well, I think Rebecca started off with the right thing. The regulators did put some belts and suspenders in the system, in that, you know, investors should only invest and can only invest a certain amount of their income depending on how much wealth they have. The other thing is, when we talk about the risk factors, which is the section, the document that details the risk, as much as, like, people's eyes glaze over and think that they are boilerplates, they are not boilerplate. They really do represent some of the risks that different companies have, and investors should read them and should understand them. And then, you know, as you said, there is just going to be a risk to it, right? Like, you know, you need to look to who the players are in the system, right? Like, you know, we have a couple of broker dealers represented here. Are there broker dealers involved in the offering? That's going to mitigate risk, because you're going to have someone who, you know, is at least like a third party, like, you know, checking the document or has some liability of their own. You know, is David and his team involved? Is there, like, you know, another party involved that's going to take some insurance and help, again, mitigate your risk? So I think it's going to be, and then who, like, you know, is involved in preparing the documents, and what does the company look like? And, you know, just for some of these companies, right, like, you know, we've seen some of the things, like, you know, we're not talking fraud, but we've seen some things for fraud, like perpetual motion machines. Like, you know, look at the company, read about the company, you know, does it even pass the laugh test? And also, depending on how you're investing, if you're doing Reg CF, all the funding portals and the broker dealers or any intermediary needs to put a communications channel in there, and the management is going to be responding to the communications channel. So ask your questions. This is your money. Don't be afraid to ask.
Okay, pass the laugh test. That's the first time I've heard that, but I'll have to admit that I've seen some offerings that I thought, you know, no way, this cannot be real. Etan, you're a broker dealer. At a high level, how does an individual investor mitigate risk?
First, only invest what you could afford to lose. Next is, oftentimes in this environment with these exemptions, it's the first time many people that are not yet accredited can invest, and it's heavily influenced by marketing and promotion. So take your time and don't get too swept up in the moment. Next is there's different types of investments, right? It's not all startups here. It's associated with startups because it democratizes and gives more access to more people to launch their startups, for sure. But these are basically exemptions. And the exemptions are tools that allow for a issuer to take whatever type of share class structure, whether it's equity or debt or fractionalizing an asset, and take this to an investor. And each one of those, I think, has a different type of a risk profile. Right, one might look at a REIT that's been around for many years, making distributions of X percentage per month, differently than they might look up someone who's an entrepreneur who has a good idea in their garage that's setting up a new co to launch, with support from their community. So I think it's important to look at it from those perspectives. And obviously, there's available information for issuers to look at on the Reg A. There's a Form 1A that has all the disclaimers, all the disclosures, who they're working with, how much they're paying, and on the Reg CF, there's a Form C again that has that information. So I would definitely look at that information as an issuer. You have time. There's plenty of deals around there, and also places like Kingscrowd that compare and contrast different types of valuations and ratings that they do is probably an interesting resource as well.
So I think you made a very good point there that not all these offerings are early stage or newco or startups. There are other types of businesses or offerings, and I think people do need to keep that in mind. So thank you for sharing that. So David, you are the risk expert, and we're going to talk a little bit later more about what your company provides. But stepping back as an individual investor or somebody who's accepting investors at a high level, what are your thoughts on individual investors, mitigating risk?
Well, I think one important thing is that you acknowledge that this is compared to a VC investor, right? And so I think one of the main differences and also a massive advantage of this industry is that it gives a lot of folks, and Eitan used the word democratize, which has been used since kind of the inception of this, almost at nauseum sometimes, but it really encompasses the thought here is a lot of these people don't know personally the folks that they're investing in. And that's a new scenario for early stage investing, right? That's a beautiful thing. But so how do you replicate some of those due diligence best practices, right? And Jamie and everybody talked about, bring the adults in the room. Who else is involved in the offering, right? And I think when you start putting folks that are responsibly doing diligence, when you can start relying on other folks being involved to say, listen, they're not going to run away with your money, or if so, there might be some repercussion. They're not lying. They're not going to steal. They're not going to egregiously funnel it for personal use. How can we neutralize this? Who's involved helping you neutralize that since you don't know this person, right? Let's neutralize those risks and let you get excited or determine if this business is going to work or not. So I think leveraging, again, like I said, the adults in the room in the industry, what are the checks and balances that you can deploy that are commonly used when somebody's sitting in an office face to face in diligencing these folks for a living. And so I think it's an interesting opportunity that the market has created. It's just kind of replicating these best practices in a new normal.
Andrew, I want to jump in there and build on something Eitan said, if that's okay, because I think it's really important because yes, there are different stages of companies we're seeing using these exemptions. I think that's important for people to realize. There's also different types of companies, right? Like what David said, there's like dividend producing REIT style investments, and then there's crypto companies. And if you look at the FINRA stats on how Americans are investing in these deals, it's aligned to what I, 10 years ago heard a financial advisor say. The younger folks are investing in the higher risk opportunities, the crypto stuff that they're very familiar with because that's the world they grew up in, as compared to the older investors who are doing a different type of portfolio. So it's actually really aligned to some of those concepts we're very familiar with.
Yeah, and I actually like to point out that if you go to business school, they always tell you that when you're young, that's the time to invest in risky ventures, because when you're older, time is running out and you want to preserve capital. And that seems to be opposed to what some policymakers want, but that's what you're taught in school. Rebecca, I'm going to continue with you because you are a massive platform providing online capital formation and for the full stack of exemptions. Deal terms, you work with different types of securities, safes, equity, preferred, debt. What are your thoughts on, is one better than the other? A lot of VCs prefer preferred, right? What are your thoughts on that for an individual investor?
I think what we see most typically is companies going public. So we see a lot of common shares or unit offerings. The thing I've been most excited about is the transformation of how I've seen warrants used, because previously to me, you did a unit offering with a common share and a warrant, and then the warrant was an overhang on the cap table and those could never get exercised. And now with warrant exercise portals, we're actually seeing when those warrants in the money, an issuer can set up an exercise portal and actually raise more capital. The investors can make more money. And that security has actually become a really beneficial thing to be issuing. So we see all different kinds of things. I think it's very contextual depending on the offering, where you're trying to benchmark your pricing to. Are you doing are you targeting an average investment price of $3,000 or $1,000 or $25,000? What is the story? What is the TAM? And then there's a security that's best going to fit as well.
That's interesting. I didn't know that there were warrant platforms. I'm going to have to talk to you more about that later because I'm curious to learn more about that. Eitan, what about valuation? Is that something that an individual investor should be, aware of?
Yeah, definitely look at it and think about it. And if you can, try to compare it, because you're spending money on something and it shouldn't just be about what you get in an inbox on a TikTok feed. It should be, you should put some thought into it. Otherwise, it's not going to reflect well on the industry or your pocket. So, more education, and I'm all for that. And it's part of these exemptions as well. The opportunity to educate, from a portal perspective. Valuation. I mean, that's interesting when you deal with startups, especially in this environment. Look at over the last 10, 15 years, there's unicorns that come up. It's like technology is going so fast that, if someone has the right team and let's say the right patents and the right moment, then, in the right favorable market conditions, who's to judge? How do you you could hate on that, or you could be open to it, but ultimately it needs to come down to the investor needs to have as much information as possible to make that decision, starting with the disclosures. But I personally believe that they should have an opportunity to support what they believe might become the next big thing, with the understanding that they're likely going to lose everything. But in the past, that wasn't easy or really available for people. And I think that gone are the days of bored apes and with people with free COVID money on their couch, wasting money on all kinds of investments, et cetera. Now, what's hot is the SEC, FINRA, transfer agents, broker dealer. I want to know my shares are over there. I want to be able to call someone and actually have this as a security. I want to know that there's a regulator that's making, that's doing their best to make sure that everything is set up properly. To me, that's really what we're seeing, a move towards regulation. But with the technology, it's not so scary to be regulated in that way from an issuer perspective. Things are still very seamless. With Reg A, you could issue freely tradable securities, fractionalization, tokenization, all that could fits very well in these exemptions. And I see that, I think that's where we're going to, continue to see more momentum there.
Okay. David, as an investor,
Okay.
do you feel you have a good handle on the difference between common equity and preferred equity?
As an investor now, because I'm a two-time founder. Before that, I don't know if I had a good grasp on it, candidly. So it's interesting. As an investor, you're also making the assumption that I'm an investor, which I'm flattered. The answer is I do now. I do participate in some angel investing. Again, like I said, unless I was in the role that I am professionally, I don't think I would have had that transparency as a retail investor in my late 20s, early 30s.
So for our audience, how would you mitigate that? Is it education? Is it speaking to somebody who's done it before? I mean, did you learn this the hard way just by slogging through it? How did you learn? David?
Oh, I'm sorry. Go ahead.
Yeah, how did you learn? How did you figure this out? Was it just trial and error?
Yeah, a little bit of the hard way. I mean, you see enough term sheets from folks, which we had the luxury of fielding term sheets. How did I learn about preferred versus common? Yeah, it was basically what was the impact to the options? What was the impact to everybody that we cared about and we wanted to satisfy as a our constituents to a certain extent were the shareholders as an operator of the business. And then there's resources. We leaned on our advisors to teach us about the repercussions of certain decisions. So
Okay. All right. Jamie, bring your legal expertise to bear here. You see all types of different security structures. Is there one that's better than the other?
I'm going to go back to what Rebecca said. I think it depends on a lot of factors, right? Like, one size doesn't fit all for all issuers. You should go to, competent legal counsel to discuss what these things mean. As David was talking about, as an entrepreneur, not all entrepreneurs even understand what a corporate structure means, right? Like, so you want to work with, legal counsel, you want to work with your broker dealer to understand what sells, what investors want, right? Like some sorts of securities, I'm not going to say are better than others, but I think, are more easily understood by the retail investor. But just keep in mind that Eitan and Rebecca and any broker dealer or funding portal intermediary has education materials available to you when you go onto the portal. So really what was it? It was a bad thing from, I'm going to date myself, an educated consumer is our best customer, right? It was a commercial that they had in
Cy
locally.
Sims.
Yeah, exactly. But it was, but that, that is going to you want to know what you're talking about. And for some companies, I think for restaurants, we saw revenue shares were a great thing because it made sense for companies that you get your money back that don't have a lot of growth potential, right? They're not going to grow, they're not going to grow they're not going to grow to billions of dollars because it's just not possible, right? And you don't want, well, other companies, if you're crowdfunding, you don't necessarily want, you're not going to want the VC stuff, right? You definitely don't, for the most part, your retail investors don't want, and nor should companies want to give any sort of significant protective provisions, because then the company's not going to be able to do things to actually grow that it's going to need to grow in order to achieve its goals. So
can you explain that for me as a non-legal person here? You're saying retail investors shouldn't want preferred? Is that what you're saying?
So preferred have many different flavors, right? Preferred is just a different type of stock other than common, and basically preferred, as opposed to common, which is normally more statute driven, preferred is more contractual. So a company can create kind of whatever it wants to, and a lot of times in a preferred stock. We see standard VC provisions in a lot of companies that give protective provisions in the preferred, that you need a majority in order to increase your number of shares. You need a majority of preferred votes. In order to do X, you need a majority of the preferred votes, etc. There could be a lot of things there could be a lot of protective provisions if you look at standard venture capital documents. It's not that it's fine, it's fine if you have a small number or a VC of preferred investors that you can go to this 5, 6, 10 people and say, hey, we need to do something. You need to sign these documents. The minute you're successful and you have a successful crowdfunding campaign, you have 20 or 30,000 people and you need 10, 5,000 people to sign a document in order to grow, to have an opportunity to do things, it's going to almost be impossible. It's going to be like herding cats if that's really what you have in your documents in order to do things.
And I would add that,
Rebecca.
yeah, Andrew, I think those provisions make sense if someone's writing a big check. Therefore, they want to dedicate the time to being involved in the company to making those decisions. Equity crowdfunding is set up for the opposite, where people are writing a small check and there's a cap on the size of their check. And so they don't have the time or desire to be that involved in making board level decisions with the company.
Okay. All right. Hey, Tom, what about an SPV? What are your thoughts on this?
Whatever is legally compliant that serves your purpose and interests and your strategy, right? So for some, they get all freaked out about too big of a cap table and they want to do whatever they can to make that more efficient. Other people don't care. It's really up to the issuer ultimately That's how we look at it. There's a number of different ways to approach that. Where we're seeing, unique SPV structures is in what we're doing on the fractionalization side under Reg A, which is a whole discussion. But again, these are ultimately tools, and the importance of having really experienced counsel that specializes in this, that has filed with the SEC dozens or over 100 times, without mentioning any names, in the industry, it's super helpful because you get to see what what sensitive issues are and maybe how to present in a different way or advise clients to avoid that, to make it make the process of qualification a bit more seamless. So I'm always for that. I think that any SPV related questions, and there's all types of questions beyond SPVs as far as creative usages of these exemptions. You want to deal with a law firm that specializes in that. And the way to find law firms that specialize in Reg A is you simply go to the SEC's website and you look at the EDGAR page, and you could search all the Form 1As and you could see all of them.
Okay. Okay. Well, let's hit it from a different angle. Amy, I'm going to jump over to you. You're doing a lot of disclosure documents, Form As. How important is it for an investor to read the offering circular or the offering documents before they invest?
I mean, I love when people read my work. So yes, the answer is yes. I mean, look, all investors should read the document, right? Because at the end of the day, you want to know what you're investing in, right? Like, you don't want to be an investor who's like, oh, I thought I invested in a company that makes widgets when they actually make I don't even know, the opposite of a widget, right? Like, you want to know what the company does. You want to know the instruments. You want to know who's involved in the company. And you want to get a sense of what the risks are, because at the end of the day, like, as you said, these companies all involve risks, and it's going to be a matter of, there's going to be a matter of a leap of faith, right? Like, you're not going in there. You're not a VC firm. You don't have the funds. You're investing a few $100s. You're not going in there. You're not touring the factory if they have one. You're not going in there and doing in-depth background checks, but you want to know who the players, you want to know what they are. And that's a way for you to figure it out. And also,
when you put risks in your documents, your work that I know I've read, I just didn't know it was you. I mean, you can have pages of this may happen, the sky may fall, or something cataclysmic could happen, sort of thing. How much effort? You said it's not boilerplate. How much effort do you, Jamie, put into risk disclosure like that?
I would say I always view a risk disclosure as our value add, to be frank. And it's one of those that we spend probably the bulk of the time discussing with the company as to what are the actual risks related to their business and their company. Yes, a lot of them are going to be standard related to, some of them are going to be standard, but a lot of them are really specific to the company.
Okay. Rebecca and Eitan, both of you, are people reading these documents? You would know that, right?
Yeah, I think the thing I love about the legislation is the fact that it needs to be one click away at all times. I think that was brilliant. I think other regions around the world need to be doing that, because that gives people continual access. And when it's in front of their face, they are going to click on it because it's readily available. It's not buried somewhere.
I don't know. I mean, if someone's making like $100 investment on a CF, that is responsive to an ad, are they going to? How many of them are going to go through the process of actually clicking and reading dozens of documents? They should, absolutely should, and it's required to include those links on it, and it's encouraged for them to. But how many actually do? I'm not sure. Perhaps what's also interesting is it's not just them that are reading these; it's other platforms that are making order out of what is included in those disclosures and disclaimers, and then like Kingscrowd, for example, and then reporting on them. And so that is another way for an investor to go and check things out. That's kind of that work's already been, or some of it's already been done. There's a perspective. There's a way to contrast and compare. I think that's also important.
Dave, as an investor, are you reading these documents because now you're a high roller and you're participating in some of the biggest private offerings available today?
As an investor, There's two different hats. As an underwriter, the answer is we are very interested in disclosure, in risk disclosures. Thank you, Jamie and CrowdCheck. As an investor, the cavalier nature is much higher than as an underwriter. I think the headlines, as an investor, no, I'm not reading them, candidly. But there's also other things. I think it goes back to, Eitan mentioned use case a little bit. I think it's came up a couple times. What's the use case for me as an investor? What I'm not doing is I'm not creating an SPV with, 50 other friends and putting a $2 million check into something, right? And so the diligence required for that as a personal investor would be far different than if I'm writing, as Eitan said, a number, let's call it, $500 that I'm able to lose and it's not going to sting that bad, right? So I think the diligence is typically going to be based on the level of risk I'm willing to take on any given investment.
Okay. All right. So we've had a lot of discussion about, how investors can mitigate risk. I guess I would kind of distill this down as to invest only when you lose a risky venture, but there are opportunities for less risky investments today, like what you mentioned, Eitan, fractional shares or real estate. Understand the terms, pretty simple. By reading the documents and figuring it out if you don't understand it, and also read up on the company and what they're trying to do and who their competitors are. I would say that's kind of what I've gotten from this. Let's jump over to the platform. So David, I'm going to go back to you because you come from a unique perspective as you do help platforms mitigate their risk, and you also do that for issuers. But I want to start with platforms here. What kind of service are you providing to platforms today?
Well, it's interesting. Is what is the service we're paid for versus what are the ancillary services? So it's interesting. I think there's definitely been collaboration around risk management and best practices. I think less now from our perspective than early on, as the industry was born. I think I'm going to use the word sophistication, but that's probably not a fair statement. But the knowledge and professionalism of folks and just the experience of folks have certainly increased over 7 years of the key participants in the industry, right? I think we've learned a lot in 7 years. So what are we doing? I mean, naturally, we're an insurance provider. So we are helping manage the downside financial risk of these platforms. On the top of that, there's risk management, but then there's also all these bells and whistles, the intimacy of this industry, the ability to adjust traditional insurance concepts to a highly transformative industry that I wouldn't call it on the bleeding edge, but certainly is changing the way investing is accomplished in the United States and other jurisdictions today. We need to adjust risk management strategies. We need to adjust how we finance that. We need to adjust a lot of things. And I think what we're doing is supporting that with some intelligence and with some collaboration. And I think with the ability to actually say, hey, we're excited about this. We're excited about what this is going to do. Let's add some additional, let's add some key pieces to the puzzle that we know are necessary for a healthy economy. And insurance is one of those.
Okay. Eitan, what type of diligence does Dalmore Group do on an issuer?
Great question. And I think the most important thing at a broker-dealer is the compliance culture. Ultimately, if you want to stay in business, then you're going to be audited. You got to prepare for that. And that's why, there's not that many out there right now. It's a very serious role. Some of the things that we do on the compliance side include, first of all, there's a bad actor check done, right? There's a background check done on the issuing entity itself and all of the officers and directors and control people involved, right? So if there's issues with that, they need to be fleshed out or they may be disqualified from participating. And then there's due diligence, right? So it depends on the exemption. For a Reg D, there's one path. For a Reg CF, there's other information that's presented. And in fact, we include CrowdCheck as part of our our Reg CF diligence process and filing of our Form Cs. And Reg A, the diligence also includes access to the Form 1A, which is a very extensive risk disclosure document and audited financials. So I say, different information is available for different exemptions. Our role as a BD is to have written supervisory procedures that we follow to do our job, to vet out and screen, to try to make sure that the wrong people aren't presenting investment opportunities, number one. But as far as, is this a good investment? We're not giving investment advice. We're not saying this is good or this doesn't have as much risk. What we're interested in making clear is that all of these investments are subject to you losing all of your money. So let's be really clear about that. And once you're comfortable with that, now you could look about what is of interest to you and what you might want to participate in.
Okay. Rebecca, what type of services do you, or what type of diligence does DealMaker do?
Yeah, same thing as Etan described, right? You've got the evolution in the space now where you have broker dealers on these offerings. When Reg A first started, that wasn't always the case. And so I think as the space matures, there are a couple different things that are leading it to be safer for everyone. It's really what David talked about is industry experts that exist now that are going deep. Firms like CrowdCheck existing, firms like Dalmore, firms like DealMaker Securities, who are going very deep in that job and following the legal guidance in the legislation, but also building best practices to fill any gaps that they see, because we all want the space to be successful. So things like, reminding an issuer after the offering is done that, hey, you've now got to use funds in accordance with your 1A and what you need to do to change your use of funds. Different practices like that evolve over time as the space gets bigger and goes deeper to making the space safer. And I think that's where you see the space differentiated from things like NFTs that go boom bust, where there really isn't that level of diligence. It's just a fad that takes off and then it busts on itself. Okay.
Jamie, CrowdCheck has been doing this for a very long time, and I'm sure you've seen a lot of changes. I'm not certain how long you've been with CrowdCheck specifically, but I'm sure you've seen a lot of changes. And you guys, typically, you work with issuers, but you also work with platforms. What do you see on the platform side for diligence and what they're doing to mitigate, issuer risk or mitigate any type of liability?
Sure. And I will say, generally we do work, we do work with both sides. I think it's a little bit of, well, first, our product, typically any issuer that we work with, we do two things, right? Like we both do an investor facing, if an issuers want it, diligence report that's available online. And then we also help draft the documents because especially for young companies, we view those go hand in hand, right? Like, companies need to know what their securities are like. There's a lot of education that goes into it. And I think, look, as time goes on, and we were just talking about earlier before this, there was an SEC enforcement for 10 issuers, and we were talking about it was, the SEC enforcement was really just for people doing compliance failure in Reg A and not filing specific documents. And we're talking about, it was more just a warning to the market. The SEC is looking. I think the fines were between 50 and 90,000. It wasn't a big fine, but it was, hey, by the way, compliance does matter. So when we get something like that, everything informs about what needs to be done and what companies are doing. When the broker dealers get something that they're like, oh, who is on my platform? Who is using us? Do any of our companies fall into this? And it becomes part of a checklist of things that everyone checks, right? And a certain, as far as what people are doing, we've definitely seen FINRA stepping up and when CF first started, I think people were just jumping in there, and now, there's stuff going on in the background that retail investors don't necessarily see, that, FINRA, who is the regulatory authority who monitors the funding portals and the broker dealers, does get involved and starts asking questions, and they have to respond to them, right? What
type of question? What type of questions are they asking? What type of FINRA calls you up? You're like, oh no, not again, right? But what type of questions are they asking?
Well, I'm going to defer to the people who would actually get the calls. On
actually
this.
answers the phone. So we'll start with Rebecca and then we go to Tom, because I know FINRA's they're not shy in calling you guys when they see something they want to ask a question about. Doesn't mean it's necessarily something wrong or bad, but I hear this frequently that FINRA sees, something that they are quick to reach out. Is that right, Rebecca?
So I get to defer a little because I'm not on the broker dealer team myself, but from what filters up to me, I think the context of our conversations with them are a lot about the new model that we're bringing to the market and them thinking about it and understanding it, because it's not a portal model, it's a standalone store that issuers are setting up. And so they're really appreciating that evolution in the market.
That's actually kind of interesting, because I didn't know that they were, watching how, the two of you specifically are evolving. Eitan?
Yeah,
Thoughts?
yeah, it's interesting. It's when you deal with money and you deal with responsibility to other people, without proper oversight, greed is very likely to enter the equation, and cutting corners and taking advantage of vulnerable people. And so one of FINRA's tasks is to do their best to make sure that broker dealers who are enabling this type of capital formation are doing their jobs appropriately. And it's not the most pleasant experience to get an email with ABC 123 ABC, et cetera, but you really need to have the proper compliance infrastructure and culture that is always seeking to improve. And you always want to be updating your procedures when you're dealing in like what we're doing, which is where technology meets innovation meets regulation. Oftentimes we're the first ones that are doing things. So you want to have kind of like compliance on your right hand, and you want to have securities counsel and advice on the left, and you want to walk forward kind of in partnership with the regulation component, with the understanding that part of their job is to find out what you're doing or what you may have missed. And so you're always looking, it forces you to have this culture of always, making, that you're going to be audited, that everything's going to be looked at. So you don't want to have pain later on, and you want to make sure you do the right things now. And you keep learning lessons of how to get better over time. And as long as, in my opinion, as long as you're not doing anything malicious and you really are doing what your best based on what the services you're offering, things will continue. But the problem is that if you do take a shortcut, or if you have a thought, action, or intention that's not aligned, it's going to get uncovered in the regulated markets. And there's like literally no room for not, being, aware of that, not being compliant. So that's kind of how I would describe it.
FINRA must love you, because you really toe the line. Don't.
No, I mean, look, I have nothing but respect, for every regulated body. I know that there are folks in the industry that have a hard time with it. My view is that you really need that type of balanced pressure, that unpredictable type of a pressure, to keep everyone honest. And that's been my personal experience with it. It's like, it forces you to always be thinking about protecting yourself and your role, hopefully protecting others, right? And that's like number one if you want to be in this game. You have to be thinking along those lines.
You have to be a straight shooter, above
Yeah.
board. David, issuers, this is wheelhouse for you. You have a key product that is designed to mitigate risk for issuers. Can you share exactly what Assuredly is doing for issuers today?
You're giving me a commercial opportunity? I'll absolutely.
Yeah, I want to hear it, because I read about it a long time ago, but I know it's adjusted and it's evolved. I want to learn about this.
So going back to kind of what I said at the beginning, when industry or when the world changes, the supporting industries need to adapt. We happen to be in the insurance space, so we really believe in the changes that are happening in the way investments are created, in the way that companies raise capital, manage cap tables, etc. We built we adapted a directors and officers insurance policy that supports issuers. It is, as far as I'm aware, the only insurance policy in the United States that proactively includes investor coverage. So if an issuer raises money from 500, 5,000, 10,000 investors, you're artificially increasing the amount of people that can sue you. That's totally fine. This is risk that just needs to be adapted for with insurance. We simply adapted that. And then we worked with the industry around best practices that the brilliant people on this panel right now are talking about, to find risk mitigation ways to adjust to a price point that actually is tolerable for the advancement of this industry, right? And then working really hard around that. So we recognize that there are risks that are always going to be prevalent, right? How severe those are, we want to make sure that we mitigate them so that it does not hold the industry back. And we believe, with the help of the regulators, with the help of the industry participants, that we are there. And I think there's still more room to improve. But going back, there is a flagship product specifically for issuers in this space. Candidly, if you're not buying this policy, particularly as a Reg A issuer, there's probably a level of your responsibility to your operations. For the folks that do purchase directors and officers, we have a very significant market share. It's called the Tiger Mark Directors and Officers Insurance product. There's a handful of underwriters. A minus.
How many platforms are you working with, or partners? How many platforms?
There's kind of two levels of platforms that we work with. So there's 32 different platforms, and we can define platforms sometimes differently, whether they're a broker dealer or they're just a SaaS platform, et cetera. And then we would count kind of 15 kind of key industry participants that are really, really driving value to us. And therefore we're adding more and more bells and whistles for the issuer. There's a very powerful investor benefit that I think you were very excited about when we discussed it. The inception or the motivation behind the investor benefit, the motivation behind reducing risk for the platforms and portals, the motivation behind reducing risk for the issuers, are all seated in the fact that we want the industries to succeed. We want to add more safety in the industry. We want to offer proper, relevant protection at a price point that is appropriate for this industry. And up to this point, I believe we're succeeding. I know there's improvements, but I think at this point, it's a very, very exciting tool and insurance product that's helping the industry move forward.
So I'd like to point out that the issuer decides to get
Correct.
Tiger Mark.
Correct.
But this is good for the investor too, because the investor gains some protection as well, right?
Legal term, the investor is not protected. So I want to be very clear on that, but there is an investor benefit. So what we did do is we wrote explicitly into the insurance policy that if there is fraud, basically somebody lies, cheats, steals, it's a bad person, right? And there's been cases of this where this has happened. If somebody does something really, really bad, right, that the investor can file that claim and get their principal investment returned as part of the insurance claim. It's an investor benefit. They're not the protected. They're not the insured. Our duty as the insurer is still to the issuer who owns the policy. But there are various things, and this all came back to our research. There are various bells and whistles that support all of the key stakeholders in the industry. The motivation kind of goes back to e-commerce and then the sharing economy. And we see a lot of parallels there. So if you go back to the late 90s, early 2000s, PayPal basically helped digitize and make payments easy online. There was an interesting company that nobody probably is aware of called SquareTrade that came as the third leg of the stool and said, hey, I'm creating access online. I'm making payments easy. Now I'm adding a symbol of trust and safety and financial security or support if something goes wrong. Same concept that we're saying, hey, get excited about the issuer, about the investment. Like, let's try to neutralize or reduce the risk that they're going to lie, cheat, and steal. Same thing with a new online transaction in the sharing economy, whether you call it Uber or Airbnb. is when you start introducing symbols of trust and safety into a online transaction among strangers, you start unlocking, more adoption and a reduced risk by using insurance as a tool for the industry to expand. That was the underlying motivation. Was it perfect? Probably not, but we were pretty dang close, right? The key risk, the key policyholder is the issuer. The platform as well as the investor both have stated benefits where they can say, hey, my risk is reduced by participating in this transaction.
So I'm gonna say that if I see an offering and it has that little tiger mark logo there, I should feel a little bit better about purchasing a security in that company. So I'm
There is a benefit.
I'm gonna make that
a benefit you as an investor have because that symbol and or policy exists. Yes, that's correct.
Okay, I'm going to jump back to the platforms very quickly here. Rebecca and Eitan, as an issuer, I'm required to put together some like true and valid information for the investors to understand from a high level. What are the requirements? I mean, they've got to propose something that's real and true. But beyond that, is there anything else that an issuer needs to provide that I need to be aware of? I'll start with you, Rebecca.
Yeah, so I think the fact that the form for the disclosure is mandated is helpful because it makes it easier to compare across offerings. And then the language that's used, folks like Jamie's team, as well as DealMaker Securities, are reviewing all the marketing materials and signing off on them to make sure that the language is compliant, that it's accurate, it's not overly promissory. All of that is mandated guidelines.
Eitan, anything to add?
Yeah, it depends on the exemption. I'll be quick, but basically for a Reg D, an issuer doesn't necessarily need to work with a broker dealer. They need subscription agreements, they need legal counsel, and they could navigate. If they could hire a broker dealer for certain purposes, if they do, then the broker dealer takes on responsibility on a Reg D to do due diligence, review and approve their advertising and promotional material, et cetera, oversee the KYC, AML, OFAC suitability, jurisdiction, et cetera, right? So Reg CF, the issuer doesn't have a choice. They have to work with a portal or a BD, and the portal or BD has to have run sufficient due diligence over the offering, which include those items I said. Reg A is a little bit of a hybrid there, depending on whether there's a broker dealer involved in the role of a broker dealer, whether it's solicit. It gets a little bit nuanced, but ultimately that's it really depends on the exemption.
And Reg A, the offering document needs to be qualified by the SEC.
Reg A, they have to file the offering circular, the Form 1A, with the SEC, give the SEC a chance to have some comments, if any, and then ultimately seek to get qualified by the SEC. The SEC doesn't approve. People oftentimes say, is it SEC approved? The SEC does not approve anything. They qualify the offering, right? Yeah.
Yeah, and CF, it's more like
a filing. It's a notice. It's a notice filing and diligence that's been done by the broker dealer. Correct.
Right. Jamie, missing anything there about what the information? I know you're neck deep in this.
No, I mean, I think Eitan did a really good thing, just clarifying the SEC, qualifies the offering document. It doesn't mean that there's not stuff wrong with the offering document, right? Like, there's always degree of risk. We can look at Coinbase, I think, had an interesting legal argument, like, a couple of weeks ago, which was, where the SEC is going after them for the, for some of the crypto stuff. And their response was, but the SEC, the SEC made effective our registration statement, right? Which is the same thing. Like, if the SEC qualifies your document, doesn't mean the SEC approves of your business or anything else. Or we saw from the recent enforcement actions, it doesn't mean like the SEC could have subsequently approved registration statements for these companies or approved subsequent Reg A's. Doesn't mean that everything you did was perfect, right? Like, that's not what it means. Right. It just means that they you're able to sell and you met the requirements for using the exemption at that point, but it's not definitive in that way. And then I just want to clarify a point that I saw in the chats where someone I think there was confusion about either like, FINRA, like, does the same thing as the SEC. It doesn't like, it's not reviewing it or saying these are good investments or not, but we're talking about due diligence. And FINRA is that it's, as Eitan was saying, it's a learning process. And as we get more feedback from the regulators about holes that there might be, whether like, in a particular broker dealer themselves or just in the market through like public, notices, everyone becomes better because ideally everyone becomes better because it's a learning experience for everybody to make the market better and make the market work better.
Okay. And something else that we pointed out before, but I want to emphasize this because it's sticky for me. There's a very big difference between failure and fraud.
Yeah.
You guys are all working to mitigate, fraud and bogus offerings to an extreme, and that's a good thing. Failure is going to happen. It's normal. It's natural. If you look at public markets today, there's been some big examples of fraud, Enron, WorldCom, the list gets longer and longer. So it's not unique to private markets. Also, some Reg D securities, which have had very smart investors participating, have, stumbled and collapsed, Theranos, okay, FTX, Andreessen Horowitz, which was a huge investor in this. There's issues out there. You can't always get it right, but you guys are working very hard to make this industry successful, productive, and good for all aspects of the industry. So before we jump over to the questions, and I see we have a couple here in the chat, is I love true life adventures. I love to hear about, reality as opposed to theory. And I just want to go around the room really quickly, and I'm going to start with you, Rebecca. Again, if you can give me just an example, you don't have to name any names, where your platform, found something that didn't work, you didn't like, you said no, or you had an experience with an offering that you addressed it in a certain way. I'm being very ambiguous here because I know you do lots of things. So tell me a true life adventure here. I want to hear a story.
Yeah, so like the compliance seminars that we run internally, I always say to people, their gut is the best thing. If anything feels off about an offering, they should report it up. We also do basic Google searches, right, which are in addition to all the statutorily mandated stuff. And I would say anyone that we've caught and chosen not to do business with has been caught by those measures that we've implemented ourselves.
That's awesome. That's good to hear. I do Google searches frequently for people who pop up on my radar I have never heard of, and if I can't figure out who they are or what they do, they're dead to me. I'm sorry. I move on. I just don't have time for that. Jamie, you have seen everything under the sun because CrowdCheck is the one. You're like the Pope of Reg A plus offerings. Can you give me a true life example of what CrowdCheck has stopped something or done something really cool to mitigate risk?
Yeah, I will start with not a true life example, but just generally issuers don't necessarily come to us if they're fraudsters, right? Like there are other lawyers in the market that they will go to. And hopefully hopefully they don't go to anybody. Like I would say most of the time, like issuers, it's more about, working with issuers, like I talked about a due diligence report, it's about helping issuers get to the point that they can sell their shares publicly, right? It's about helping and you said young entrepreneurs, and we'll use young in quotes because I feel like entrepreneurs just want to say can, run the gamut, and they might be seasoned entrepreneurs or they might be, people who are young to entrepreneurship and those are all our clients. But entrepreneurs sometimes just it's about working with them to understand what the risks are and understand how to help them with their company and setting things up. I think most it's about working with clients and helping them do better is ideal. And if they can't, then they can. And I think sometimes people just don't understand what the rules are, right? It's not a lot of malfeasance, it's about education, right? And I'll use example of 17B disclosure, which is the disclosure that if someone pays you for securities, you need to put different disclosure. We always that's what certain celebrities get in trouble for. And we call that like low hanging fruit, right? Like, did you do it or did you not? It's easy pickings, right? Like, and I think there's just a lot of, there's a lot of people out there who just don't know the rules. And it's a matter of like education and like, working with competent people who know the rules to help them navigate the system. And for that one, like for 7 to 17B stuff, I feel like, look, there was an example with Taylor Swift, right? Like, she got her name out there because she was like a celebrity who, like, when people came to her with some of the FTX stuff and when do you want to sponsor it, she's like, is this a security? And she knew enough to ask the right questions or was counseled well enough to ask the right questions. And that's what we want for issuers and like, investors alike.
Okay, so beginning today, I'm going to describe myself as seasoned. Okay, I'm not a young, I'm a seasoned entrepreneur, so thank you. I have a new term. It's
it happens very frequently that we have to turn down from service issuers because of a host of issues that come up. Obviously, if anything vibe-wise from a compliance officer, it doesn't feel right, then we'll pass. But things happen with background checks that come up, and judgment calls have to be made. And ultimately, what's interesting is that it's not like executives at a broker-dealer call the shots. It's the compliance officers ultimately, is in addition to the executives, have very specific responsibilities. And the right culture that you have to create is very interesting in a broker-dealer because the compliance officers, you don't tell them what to do. You have to hire them and they have to make decisions on their own. And you have to respect those decisions and you have to add to that. It's very different than saying, get this done. It's not, that doesn't work in the regulated space. And so all kinds of things come up and we've had to let issuers go, existing clients, good existing clients, because something happened with a state issue or something happened that they didn't properly disclose or something, whatever our compliance officers ultimately determine in their scanning of different deals or new information that presents itself, they have to make a judgment call. And sometimes it's hard to let people go, but that's frequently things that happen to us, and they go to other platforms. That's the issue. It's not like they go away. It's like we see them show up on other platforms. Yeah. We're like, okay, whatever. Everyone has their own process, I guess.
Okay, we're running close to the end of our time, so I need to keep this moving because I do want to get a couple of questions. David, I know you have some good stories where something bad has happened, and you guys have rushed in to save the day. Give me an example.
Well, we try to make sure nobody hears about it, right? That's one.
I know. That's why I'm asking.
So let's do a couple of things. Let's do what and I'll go fast, I promise. The issuer who's the insured, and then there's beneficiaries like an investor, right? So a squeaky wheel investor, whether they have a bad hair day, but there's one issuer specifically that, mind you probably wasn't the most pleasant operator, but there's just no communication post-race, which I would not advise as best practice, but that person also did not break a law, did not do anything wrong, was still operating their business. 3 individual investors, and they didn't have a ton of investors, but a couple hundred investors. 3 individual investors raised their hand and said, I want my money back. He just doesn't respond to anybody, right? So that, although not a legal claim, there's no lawyer, we stepped in and dealt with that from a legal perspective on behalf of the issuer in the terms of the insurance policy. We also advise the issuer to change some best practices going forward as a condition of hopefully like maybe your price will be affected at renewal. On the flip side, where the issuer was in the wrong, and this is the investor benefit a lot of people are talking about, we had an insured, somebody that we owned insurance in a Assurely Tiger Mark insurance policy, flat out ran away with the money. Couldn't find him. Investor raised, single woman raised her hand, $20,000 investment. And she was returned her investment less a couple fees for people processing it. Basically now we're going to go try to find this guy and take the money back. So basically the case was the person stole the money, the issuer, and the investor filed a claim, and we returned the principal investment as part of the insurance policy. The investor was not the insured, but based on the investor benefit that was in the policy,
Right.
we were able to and there's a ripple effect to this. So this becomes headlines. That is not good for anybody in the industry, right? So what we're trying to do is put safety precautions in the industry. Are there going to be mistakes? Absolutely. Are people going to try to build companies and make mistakes because they're building companies? Yes. Are people allowed? Should people be able to take the money and run off? Absolutely not. And we need to put precautions in place. So the issuer was the insured, but we did use the insurance capital as part of the policy to support safety in the industry in that instance.
So it was a happy ending, even though you had the big rug pull
I wasn't
and
excited that
she vaporized, but the investors got their money back. Okay, so I'm going to jump over to a couple questions very quickly. Yeah, this is one that actually kind of interests me because I know there's all sorts of ways to do it. Is what does a bad actor check include besides Googling? I'll ask you, Rebecca.
I'm probably not the best person to ask about that.
All right, we'll jump to Jamie because she does a lot of this.
So the bad actor requirements, in order to do Reg A, Reg CF, and Reg D, you can't be a bad actor. And under the statute, it defines what a bad actor is, which includes certain financial crimes, fraud crimes, or whatever convictions by regulators or in the U.S. The SEC, bars from being part of the SEC, etc. So a bad actor check, typically includes checking certain databases out there that contain this information, right? And there's two things for, bad actors. These are the things that disqualify you, but also there are also things that might come up in a bad actor check that are not disqualifying, but should be disclosed, right? Bankruptcies, you can certainly be an issuer if you've had a bankruptcy, but if you've had a recent bankruptcy, maybe if you were 21 years old and now you're 60, probably don't need to disclose your bankruptcy. But if you had your bankruptcy last year, it's probably something that investors may want to know if you're going to take their money. And it's not a barring offense, but it's definitely something that you want to make sure you get ahead of and get out there.
Okay, here's one, and I'm going to streamline this question a little bit. Eitan, how can compliance, I guess, manage over enthusiastic founders? And this is actually a good question because if you're a founder, if you're an entrepreneur, you are naturally optimistic. If you're not, you're in the wrong business. Get out, do something else. You have to be excited about the business you're pursuing, your dream and what you're trying to accomplish. And so I have seen this happen where people, they may, extrapolate their performance going forward to some ridiculous end. How do you manage that as a platform? And maybe I'll ask you to, Rebecca, because I'm going to start with Eitan.
First, the issuer needs to have good legal counsel so that they make sure that their advertising and promotional materials aren't considered fraudulent, right, from the SEC. Second is the issuer is going to want to present information ideally in a fair and balanced way, without saying things that are unwarranted and without saying things that are promissory. And this is designed to just be fair with investors who might not be, quote unquote, they call sophisticated. That's a ridiculous word, but early, young, naive, easily impacted by what happens on their iPhone. So there's responsibility and there's checks and balances at different stages along the way. That include things like audited financials, having securities attorney, having a broker dealer, getting there's multiple processes involved. These are some examples.
Rebecca, how do you manage that?
Yeah, no, I think Eitan covered it. I think following those procedures and making sure that every I is dotted and T is crossed is the way to do it.
Jamie, David, anything to add?
I think the one thing that's been brought up, all the folks in the panel today, so technology as well as the influence of technology to help best practices. I think that's also one of the things that as that continues to increase and the value proposition of the investment in technology increases, I think you're going to continue to be able to flesh out. And from our perspective, it makes our ability to deliver less expensive insurance to the market there. So I think technology also might not have been discussed enough, although referenced as best practices to help enable some of these things, and make sure we kind of touch on that before we're done.
Okay, awesome. All right, I'm going to cut it off here because we're far over time, running out of time. I want to thank each of our panelists, David, Eitan, Rebecca, and Jamie, for joining us today and sharing your wealth of information and your expertise. I want to remind everybody who's here that on June 14th, we'll be doing a real estate webinar, which should be very interesting, especially in the current economic environment that we are in today. So once again, thank you everybody for joining us today, and we look forward to the next one, and have a great rest of the week. Thank you.
Thanks, everyone.
Thank you.